Welcome to Seeds of Wisdom team. I will never look at my tax returns the same way after learning these 2025 updates. Let's dive in. Big news for taxpayers in 2025. The standard deduction is up. $15,000 for singles, $30,000 for married couples, and $22,500 for heads of households. That's more money in your pocket. AMT exemptions rise too, helping middle-income earners avoid extra taxes. And if you're a high earner, new bracket adjustments mean the top 37% rate kicks in at higher incomes. Commuting? Monthly allowances jump to $325 for transit and parking. Health FSAs now let you stash $3,300 tax-free with a $660 carryover. For our international friends, the foreign income exclusion is $130,000. And families? The EITC and adoption credits are higher, plus estate tax exclusion is nearly $14 million. Invest smart, max out IRA, HSA contributions, and watch those crypto gains. Here's a breakdown of the key tax changes announced by the IRS for 2025 and a few tax-saving tips for investors. Key changes for taxpayers in 2025: 1. Increased standard deduction, O single filers, $15,000, up $400 from 2024. O married filing jointly, $30,000 a heads of households, $22,500. This boosts savings for those who don't itemize deductions, especially helpful amid inflation. 1. Adjusted Alternative Minimum Tax, AMT. Exemption O individuals, $88,100, a married filing jointly, $137,000. This update may help some middle-income earners avoid the AMT, reducing tax liability for qualifying taxpayers. 1. Income tax bracket adjustments. O top tax rate of 37% now applies to individuals earning over $626,350 and married couples over $751,600. This ensures higher earners aren't penalized by inflation-driven income growth. 1. Commuter benefits. O monthly allowance, $325 for transportation and parking expenses, which helps workers with high commuting costs, particularly in urban areas. 1. Health Flexible Spending Account, FSA. Contribution limit, O raised to $3,300 with a carryover maximum of $660, allowing workers more flexibility in managing healthcare expenses. 1. Foreign Earned Income Exclusion. O U.S. citizens working abroad can exclude up to $130,000, which is beneficial for those living and working outside the U.S., reducing potential double taxation. 1. Earned Income Tax Credit, EITC. The maximum EITC for families with 3 or more children increases to $8,046, supporting working families with moderate incomes. 1. Estate tax exclusion. Increase. Exclusion rises to $13.99 million, benefiting estate planning for high net worth individuals, allowing more assets to pass tax-free to heirs. 1. Adoption credit increase. New maximum credit is $17,280, which helps adoptive parents manage qualified adoption-related expenses. Tax tips for investors: 1. IRA contributions. Max out contributions to traditional or Roth IRAs for tax savings. Those under 50 can contribute up to $7,000, while those 50 plus can add a $1,000 catch-up. 1. Self-employed retirement plans. Solo 401(k)s and SEP IRAs allow self-employed individuals significant tax-saving opportunities with high contribution limits. 1. Max out HSA contributions. The 2025 limit is $4,300 for individuals and $8,550 for families. HSAs offer triple tax benefits. Contributions, growth, and withdrawals for medical expenses are all tax-free. 1. Capital losses. Claim losses on investments up to $3,000 to offset gains and reduce taxable income. Be mindful of the wash sale rule, which could disqualify certain loss claims. 1. Cryptocurrency gains losses. Be sure to report gains and losses from crypto transactions, as failure to do so can lead to IRS scrutiny. 1. Watch for K-1 forms. For those invested in partnerships, K-1 forms may arrive late. You may need to amend your return if you file early and receive it afterward. 1. Year-end investment planning for 2025. Assess your portfolio and consider selling losing investments to optimize your tax situation for the following year. Bottom line, these changes could mean significant savings, especially for middle-income earners, families, commuters, and those with international income. Consulting a tax professional can help you fully leverage these adjustments and refine your tax strategy. Here's a deeper dive into how these tax changes for 2025 could affect various taxpayers and strategies to maximize savings. Expanded deductions and credits, standard deduction. Increase. This increase in the standard deduction provides more opportunities for middle-income families to reduce their taxable income without itemizing. Taxpayers in high-tax states or those with moderate expenses may find they no longer need to itemize, simplifying the tax filing process. Earned Income Tax Credit, EITC. Increase. For low to moderate income families, especially those with 3 or more children, the boost in the EITC to $8,046 provides a substantial benefit. This tax credit not only lowers tax liability, but can also result in a refund, providing additional financial support in times of rising living costs. Adoption Credit Adjustment. With adoption expenses often significant, the increased adoption credit, up to $17,280, is a meaningful adjustment for families looking to adopt. It offsets qualified costs associated with adoption, such as agency fees, court costs, and travel expenses. Wealth transfer and high-income bracket planning, estate tax exclusion. Bump. High net worth individuals and families have more flexibility in estate planning with the increase to $13.99 million per person for estate tax exclusions. For couples, this means potentially shielding up to nearly $28 million from federal estate taxes, enabling more tax-efficient wealth transfer to heirs. Alternative minimum tax, AMT adjustments, with the AMT threshold rising to $88,100 for individuals and $137,000 for married couples, more middle-income earners could escape AMT liability. This adjustment is valuable for those with additional income sources or significant deductions, as it reduces the likelihood of AMT application on their taxes. Higher income bracket limits. The increase in income thresholds for each tax bracket helps prevent inflation-driven wage increases from pushing taxpayers into higher brackets. For instance, single filers won't reach the 37% top bracket until they earn over $626,350. Reducing the chance of bracket creep, where income adjustments could inadvertently lead to higher taxes. Benefits for workers and commuters, Health Flexible Spending Account, FSA. Increase. With healthcare costs rising, this increased FSA limit allows workers to set aside more pre-tax dollars for medical expenses, effectively reducing their taxable income. The carryover limit, raised to $660, helps employees retain some funds for future years, ensuring they don't lose unused contributions. Commuting benefit expansion. The increased monthly transportation and parking benefit of $325 can make a noticeable difference for employees who face high commuting costs, especially in urban centers. Those receiving employer-sponsored commuting benefits may see more of their transportation costs covered pre-tax. Expat and global income adjustments. Foreign earned income exclusion. Increase. U.S. citizens working abroad benefit from a higher exclusion limit, up to $130,000. This change lessens the tax burden for Americans earning income overseas, reducing the impact of double taxation on foreign earned income. Tax-saving strategies for investors and self-employed individuals. 1. Capital gains and loss harvesting. Investors can use capital loss harvesting to offset capital gains, potentially lowering their tax liability. Taxpayers can claim a net loss of up to $3,000 against other income, with any excess losses carried forward to future years. Avoiding wash sales, repurchasing the same security within 30 days, is key to benefiting from these losses. 1. Maximize retirement contributions, OIRAs. Max out traditional or Roth IRA contributions by tax day to reduce taxable income or enjoy tax-free growth, Roth IRA. Those over 50 can contribute an additional $1,000 as a catch-up. Self-employed plans, solo 401(k)s and CPIRAs offer higher contribution limits, allowing small business owners or freelancers to shield more of their income from taxes. 1. Health savings accounts. HSA. The 2025 HSA limit increases to $4,300 for individuals and $8,550 for families, with an additional $1,000 per spouse over 55. For those with high-deductible health plans, HSAs are a triple tax-advantaged account, tax-free contributions, growth, and qualified withdrawals, which can effectively serve as both a health and retirement fund. 1. Cryptocurrency reporting. Ensure all crypto transactions, including sales or purchases, are reported to avoid IRS penalties. Claim losses on crypto positions to reduce your taxable income. 1. Watch for late-arriving K-1 forms. Investors in partnerships may receive K-1 forms late, sometimes even after the tax deadline. Filing an amended return with the K-1 information ensures accurate reporting and prevents potential audits. Forward planning, 2025 and beyond. Plan estate transfers early. With the estate tax exclusion increased, it's wise to work with estate planners to make the most of this opportunity if wealth transfer is part of your strategy. Monitor tax law updates. Staying updated on further tax changes can help you adjust your strategies in advance and make timely tax-efficient decisions. Final thoughts. Navigating these tax changes can be complex, but they offer valuable opportunities to reduce tax liability, save for retirement, and enhance wealth transfer. Tax professionals can help tailor strategies to individual circumstances, ensuring that taxpayers maximize the benefits available in 2025 and beyond. The IRS just announced big tax changes for 2025. Here's what they are and how they could impact you. The IRS just dropped a raft of changes, big and small, to the U.S. tax code that could shift how much you owe or save in 2025. From bigger deductions to higher limits on health-related savings accounts, the changes reflect the government's continued fight to curb inflation and resulting financial strain. The adjustments, announced by the IRS in late October, are designed to bring some relief to taxpayers through increases in standard deductions, tax bracket thresholds, and other key areas. Some of the changes are related to adoption, commuting, and earning income from outside the country. In high-cost cities, the transportation benefit hike may bring some relief, while changes to medical savings options give families more flexibility to manage healthcare costs. If you're in a higher tax bracket or plan to leave an inheritance, it's worth paying attention to the alternate minimum tax (AMT) and estate tax changes. The standard deduction increase and the earned income tax credit boost will directly benefit middle-income families, while commuters and people living or working abroad will also find things to like. In all, the IRS announced more than 60 changes for the upcoming tax year. Below, we identify the 9 of the biggest. How much they'll impact you depends on your income, financial health, and tax strategy. As with any tax updates, it's smart to consult a tax professional on how to make these changes work for you. And it's important to remember these changes take effect in the 2025 tax year. They won't do you much good when it's time to file your returns this coming spring. You deserve a break. Here's one change nearly all American tax filers will get to enjoy. The standard deduction is going up. For the 90% or so who don't choose to itemize their deductions each year, that means a little extra cash to help offset the persistent effects of inflation. Single taxpayers can now deduct $15,000, a $400 increase from 2024. Married couples filing jointly get a bump to $30,000, while heads of households can claim $22,500. This increase could mean paying less in taxes, especially for those who don't itemize. Middle-income earners will be happy to hear that the alternative minimum tax exemption, designed to ensure that high earners pay a minimum tax, has increased to $88,100 for individuals and $137,000 for joint filers. It's a modest increase from the previous tax year's minimum of $85,700, but this adjustment could result in some middle-income earners no longer being subject to the AMT, which could result in tax savings for them. That might not be the case if you got a raise, but the good news is that the IRS has prepared for that as well. For 2025, the IRS has adjusted income tax brackets to accommodate rising wages. The 37% top tax rate applies to singles earning over $626,350 and married couples earning over $751,600, an increase from $609,350 the tax year before. And other bracket adjustments this year could result in some households falling into lower tax brackets, potentially lowering their tax bills. Read more. Rich young Americans are ditching the stormy stock market. Here are the alternative assets they're banking on instead. Work hard, keep more. Are you one of the millions of American workers who are back to commuting to the office a few days a week? For those who receive employer-sponsored benefits, the IRS raised the monthly allowance for transportation and parking to $325. This may be especially helpful in urban areas where transportation costs are steep. Employees can also now contribute up to $3,300 to health flexible savings accounts, with a carryover maximum of $660. This increase allows workers to set aside pre-tax money for medical expenses, helping ease the burden of healthcare costs. And as for those who've sought a new life outside of the U.S., Americans working in other countries can exclude up to $130,000 of foreign earned income in 2025, up from $126,500. This adjustment helps U.S. citizens abroad by minimizing their taxable income and alleviating double taxation. Family-friendly policies. In 2025, the maximum earned income tax credit for low to moderate income families with 3 or more children rises to $8,046, a slight increase from this year. This credit helps support working families, especially as living costs rise, and provides a valuable income boost for qualifying households. Higher earners, on the other hand, will now be able to pass on more of their money to family, friends, and the causes they believe in as the estate tax exclusion jumps to $13.99 million for estates in 2025. This change could significantly impact high net worth individuals and estate planning, potentially protecting more assets from estate taxes. As for those looking to start their families, the IRS has introduced a new rule for parents. The maximum adoption credit increased to $17,280, up from $16,810. For adoptive parents, this credit covers qualified expenses, reducing the financial burden associated with adoption. 7 top tax tips for investors. The deadline to file your taxes may be closer than you want, but there's still time for investors to get their tax affairs in order. While filers with investments have to get most of their tax situation sorted before the prior calendar year ends, there are still areas to pay particular attention to and ways to save now. Here are 7 top tax tips that even last-minute filers can take advantage of. 1. Contribute to an IRA. Contributing to a traditional IRA is one of the last best ways that many working Americans can slash their taxes after the calendar year has ended. Even if you make too much for a tax break on a traditional IRA, you still have the option of a Roth IRA, even if it's a backdoor Roth IRA. You'll have until tax day to make your contribution and take advantage of this route. Maxing out your investments into your traditional or Roth IRA is a great way to save money for the long term, says Eric Bronnenkamp, head of tax at Edelman Financial Engines. A traditional IRA can allow you to contribute with pre-tax income, meaning you won't pay tax on your contributions. The money can grow tax-deferred for years, and only when you take it out in retirement will you owe taxes. A Roth IRA uses after-tax income, meaning no tax break today, but you'll enjoy tax-free growth on your money and tax-free withdrawals in retirement. The maximum contribution for an IRA is $7,000 in 2024 and 2025 for those under age 50. Those who are age 50 and older can make an additional $1,000 catch-up contribution. However, IRAs have income limits, so it's important to be aware of them. If you make too much to enjoy tax deductibility from a traditional IRA, you may still be able to receive an attractive tax benefit from a Roth IRA. Make too much for even the Roth IRA, and you'll need to turn to the backdoor Roth IRA, which allows workers to convert an account, but not without some catches. Here are the best brokers for Roth IRAs. 1. Add to your self-employed retirement account. If you run your own business, even a sole proprietorship, you can get tax advantages for contributing to a self-employed retirement plan, such as a solo 401k or SEP IRA. Both have sizable contribution limits that can help you reduce your tax bill today. The solo 401k works like a regular 401k, but for single-person businesses. It comes in two variants, a traditional version offering tax-deductible contributions with tax-deferred growth, and a Roth version that allows you to grow your money tax-free and withdraw it tax-free in retirement. You can contribute to both a solo 401k and a regular IRA, allowing you extra tax benefits. The SEP IRA is a plan for individuals and small companies, and it functions similarly to a traditional IRA, but with much higher maximum contributions. Contributing to a SEP IRA also doesn't limit your ability to contribute to a regular IRA, meaning you can get both tax benefits. The solo 401k and SEP IRA have contribution limits, and you'll need to follow the rules closely. Here are the differences between the solo 401k and the SEP IRA and which may be better. 1. Max out that HSA. It's easy to forget that a health savings account, HSA, gets you a tax deduction, but it can. And you'll still be building a fund that you can use for medical expenses later on. This option is available only for those who are covered by a high-deductible healthcare plan, though. The HSA is triple tax advantaged, as the contributions are pre-tax, earnings are tax-deferred, and withdrawals for qualified medical expenses are tax-free, says Bretton. You'll have until the tax deadline to contribute, and the HSA contribution limit for an individual is $4,150 in 2024 and $4,300 in 2025. For a family, those limits are $8,300 in 2024 and $8,550 in 2025. Each spouse older than age 55 adds an extra $1,000 to the contribution limit, meaning a family with two spouses over age 55 could contribute up to $10,300 in 2024. That's some serious tax savings if you can afford to pack away that much money. Plus, your HSA can be used as an additional retirement plan because withdrawals can be used for any reason after you reach age 65. You will pay taxes on withdrawals used for non-medical expenses, however. 1. Claim capital losses, but don't get tripped up by wash sales. As you're reporting any sales of stock or even your home sale, make sure you're claiming any losses on your return. Capital losses can offset capital gains, ultimately reducing your tax bill. In fact, you can claim a net loss of up to $3,000 on your return, so make sure to report any losses. As you're doing so, however, don't get tripped up by the wash sale rule. A wash sale occurs when you sell an asset for a loss but have purchased the same asset within 30 days before or after the sale. Wash sales are specifically excluded from being claimed on your return. If you try to claim a wash sale, the IRS will politely refigure your return and bill you if necessary. The loss from a wash sale is not gone forever, though. Once you finally sell the asset and refrain from repurchasing it for 30 days, you can claim the loss and get your tax benefit. 1. Declare your gains and losses from cryptocurrency. If you're investing in cryptocurrency, not only do you have to declare that you've sold or received it in 2024, you also need to report any realized gains, that is, gains from selling a position. But given the volatility in cryptocurrency, investors may have losses, so be sure to claim those too. You're on the hook for any taxable gains from crypto trading, even if you didn't receive a Form 1099 from your exchange. And while you're at it, make sure you're claiming your losses and get every tax benefit that you're legally owed. Here's how to report your gains and losses correctly on your tax filing. Finally, don't forget that if you've spent cryptocurrency, you could have a gain or loss too, and according to the law, you could create a tax liability or benefit from that. 1. Watch out for K-1 forms. If you're invested in a partnership or a publicly traded partnership, you should be receiving a K-1 form that details your tax situation, including whether you've received any payouts from the firm. The K-1 form may be easy to overlook because it's not a 1099 and, unfortunately, is often delivered late in the tax season. In fact, sometimes it may appear even after the tax deadline. That means if you've already filed your return, you'll have to submit an amended return. That's not particularly difficult, especially if you're using tax software, but it can be annoying. 1. Start planning for 2025 taxes. Did you miss the year-end deadline for selling your losing investments and claiming a tax write-off? That's one of the biggest ways that investors can reduce their taxable income. And if you don't sell during the 2024 calendar year, you won't be able to claim them on taxes in 2025. So take this opportunity to evaluate whether you need to unload some losing investments now to reduce your taxes later. While many investors wait until the last month of the year to sell a loser, there's no legal or tax reason that you need to do so. Plus, you may be able to avoid the inevitable scramble at the end of the year when your life is already too hectic. Bottom line, once the calendar year ends, investors have limited ways to really reduce their taxes. However, they do have avenues to make sure that they're claiming every deduction they're entitled to. Plus, properly and completely filling out your tax form helps keep the IRS from looking more closely at your return than it already does. Bankrate's Rachel Christian contributed to an update of this article. Show comments, tax credits or tax deductions, which will save you more. Although paying taxes is a fact of life, the IRS offers taxpayers the ability to reduce what they owe via various tax deductions and tax credits. But it's not as simple as it sounds. Before you can qualify for each deduction or credit, you must meet specific criteria. And even though both deductions and credits can lower taxes, the way that they affect your overall tax bill and potential tax refund can be very different. Here's what you need to know about the differences between tax deductions and tax credits and how they can help you reduce your tax bill and maximize your tax refund. Exclusive American savings drop to lowest point in years, tax deduction versus tax credit. What it means for your tax refund. The primary difference between a tax credit and a tax deduction is that a credit reduces the amount of tax you owe and a deduction reduces your taxable income. How a tax credit affects your refund. The value of a tax credit is easy to measure because each dollar of credit reduces your tax liability by $1. For example, if your tax liability for the year is $10,000 but you have a $2,000 tax credit, your tax liability drops to $8,000. If your liability was $2,000, the $2,000 credit would reduce it to $0. What that means for your refund depends on how much tax you paid during the tax year. Had you paid the entire $10,000 tax liability through tax withholding from your paycheck, you'd receive a $2,000 refund. If, on the other hand, you'd only had $8,000 withheld, you wouldn't owe any additional tax, but you wouldn't get a refund because you'd have paid the amount you owed after applying the credit. How a tax deduction affects your refund. How a tax deduction affects your refund depends on your tax bracket because a tax deduction only reduces your taxable income. Our tax bracket is the one that applies to the last dollar you earn. So if you had $40,000 in income, you'd be in the 12% tax bracket. Your first $11,000 would be taxed at 10%, and your income from $11,001 to $40,000 would be taxed at 12%. The tax rate for your last dollar earned, 12% in this example, is your marginal tax rate. The higher your marginal tax rate, the bigger your potential refund. To find out how much a deduction saves you, multiply your marginal tax rate by the amount of the deduction. For example, if you can deduct $7,000 for the contributions you made to a traditional IRA and you fall in the 12% tax bracket, multiply $7,000 by 0.12 to find that the deduction saves you $840 on your taxes. If you were in the 32% tax bracket that tax year, that same $7,000 deduction would save you $2,240. Learn more. 10 tax loopholes that could save you thousands. What are tax deductions? Tax deductions are write-offs that you use to reduce your taxable income before you calculate how much tax you owe. For example, if you make $55,000, but you qualify for a $1,000 tax deduction, your taxable income drops to $54,000. Deductions the IRS allows include adjustments to income and a choice between the standard deduction and itemized deductions. Adjustments to income. You can claim adjustments to income, sometimes referred to as above-the-line deductions, regardless of whether you claim the standard deduction or itemize your deductions. Adjustments to income include student loan interest, traditional IRA contributions, educator expenses, contributions to health savings accounts, standard deduction versus itemized deductions. The standard deduction makes it easier to do your taxes because it's a flat amount, $14,600 for individual filers, $29,200 for married joint filers. No worksheets, schedules, or calculations needed on your part. But some taxpayers get a bigger break by itemizing deductions. Itemized deductions are individual expenses the IRS lets you deduct from your taxable income. Some of the more common ones are charitable donations, gambling losses, up to the amount of your winnings, medical expenses that exceed 7.5% of your adjusted gross income, mortgage interest, property tax, up to certain limits. Each year, you have to decide whether to itemize your deductions or take the standard deduction. Tax credits provide the most benefit to lower and middle income taxpayers. The reasons are that many credits have income limits, and lower income means lower tax liability or even no tax liability. Refundable and partially refundable credits like the earned income and child tax credits provide refunds for these taxpayers, even if they haven't paid or overpaid tax. Tax deductions, on the other hand, benefit higher income taxpayers by reducing taxable income. If deductions reduce taxable income enough, they could bump the taxpayer into a lower tax bracket. In that case, the taxpayer reaps additional savings by paying a lower tax rate on their already reduced taxable income. Upcoming tax changes to watch. For every year, the IRS makes changes that can affect your tax liability. Here are some of the changes the IRS has announced so far for 2025. The standard deduction will increase by $400 to $800 depending on your filing status. Tax brackets remain the same, but marginal tax rates within each bracket apply to higher income amounts, which could reduce taxes for some taxpayers and keep others from landing in higher tax brackets. The earned income tax credit increases by $216. Exemptions for the alternative minimum tax increase, which helps more taxpayers to avoid it. Strategies for maximizing your tax credits and deductions. Taxes are inevitable for most Americans, but you can ease their burden by taking steps to maximize credits and deductions. Research tax deductions and credits so you'll know what you're entitled to claim. The IRS website located here is an excellent resource. Keep accurate financial records and organize deductible and credit-eligible expenses by category. At the end of the year, total them to them so you'll know whether to take the standard deduction or itemize your deductions. If you're married, calculate your tax liability as separate filers and joint filers, both to see which is most beneficial. Contribute the full allowable amount to your tax-deferred retirement accounts and flexible or health savings account. Schedule potentially deductible end-of-the-year spending such as mortgage payments for mortgage interest, medical expenses, business expenses, and charitable contributions for when they'll benefit you most at the end of this year or the beginning of next year. Many retirement savers with sizable tax-deferred accounts like a 401k are interested in converting those funds to Roth accounts so they can escape having to pay required minimum distributions, RMDs, and the associated taxes after they retire. It's not always the right move, in part because of the hefty upfront tax bill on conversions. However, in the right situation, this can be a solid financial move. For instance, a saver who expects to be in a higher tax bracket after retirement may be better off paying taxes on a conversion at their lower current rate now. Consider weighing the pros and cons of converting your retirement account with the assistance of a financial advisor well-versed in the details of these transactions. Converting to avoid RMDs. RMDs are mandatory distributions that retirement savers with tax-deferred accounts must start withdrawing from their accounts starting at age 73, whether they need the money to pay expenses or not. These withdrawals are fully taxable, which can cause retirees to pay more income taxes than they would like, and in the worst case, move into a higher tax bracket. Transferring funds from a 401k or other tax-deferred account into an after-tax Roth account lets retirement savers plan for a future without RMDs, because Roth accounts are not subject to RMD rules. Furthermore, Roth withdrawals are tax-free in retirement, further reducing the retiree tax burden. The downside of Roth conversion is the current tax bill. Converting $75,000 of 401k funds to a Roth increases the saver's income by $75,000 for that year. Assuming the saver is single with household income of $75,000, this will bump them from the 22% marginal income tax bracket to the 24% bracket. Their federal income tax bill will increase from approximately $8,800 to $26,000. Another potential problem with converting is that rules prohibit tax-free withdrawals of converted contributions for 5 years. In the majority of cases, the 5-year rule means they may have to pay taxes on Roth withdrawals unless they delay retirement until 5 years after conversion. While converting will avoid RMDs, it may not reduce the overall tax burden compared to not converting. For instance, a retiree may be in a lower tax bracket after retirement. If that happens, it may save money to leave the money in the tax-deferred account and pay the taxes on withdrawals after retirement. A financial advisor can help you weigh the tax bill trade-offs in your situation. It's important to keep in mind the fact that conversions cannot be undone. It is strictly a one-way procedure, so a saver is well advised to be absolutely sure that this is the right move before executing a conversion. Roth conversion strategies. Gradually converting 401k funds to a Roth can help manage and potentially reduce the overall tax bill. For instance, converting the entire $750,000 in 1 year is likely to put a taxpayer in the highest 37% tax bracket depending on their income. That would generate an estimated $232,708 tax bill on the converted amount. Converting $75,000 a year could at least spread this charge out over several years. Converting at that rate is unlikely to completely drain the 401k, however, because the funds in the tax-deferred account will continue to grow as the conversion process gradually moves them to the Roth account. For instance, assuming the tax-deferred investments earn 7% average annual return, converting $75,000 annually for 13 years until RMDs begin at age 73 would leave approximately $180,738 in the account. Converting larger amounts would increase the annual tax bill, while converting smaller amounts would mean leaving even more funds in the tax-deferred account where they would be subject to RMDs. This may not be a bad thing, however. It often makes sense to have funds in both tax-deferred and after-tax accounts in retirement to allow for some flexibility in tax planning. If you have questions about the best strategy for your retirement, consider using this free tool to match with a financial advisor. Bottom line, transferring tax-deferred retirement funds into an after-tax Roth account can be an effective way to reduce or avoid having to pay RMDs. However, it's far from a cost-free move. It can be tricky to balance the expenses against the gains in order to make an optimum decision about how and whether to proceed with a conversion. Key concerns include planned age at retirement and projected tax bracket after retirement. Tips: consider meeting with a financial advisor to discuss plans for converting tax-deferred retirement account funds to a Roth account. Finding a financial advisor doesn't have to be hard. Smart Asset's free tool matches you with up to 3 financial advisors in your area, and you can interview your advisor matches at no cost to decide which one is right for you. If you're ready to find an advisor who can help you achieve your financial goals, get started now. You can get an idea right now of how much you'll owe come next tax day with the help of Smart Asset's Federal Income Tax Calculator. Keep an emergency fund on hand in case you run into unexpected expenses. An emergency fund should be liquid, in an account that isn't at risk of significant fluctuation like the stock market. The trade-off is that the value of liquid cash can be eroded by inflation, but a high-interest account allows you to earn compound interest. Compare savings accounts from these banks. Are you a financial advisor looking to grow your business? Smart Asset AMP helps advisors connect with leads and offers marketing automation solutions so you can spend more time making conversions. Learn more about Smart Asset AMP. For more tips, consult a tax pro and keep those savings rolling in 2025. Don't miss the bus and subscribe.